In the U.S. stock exchange, ETFs traded with $9.6 trillion in 2022 alone. With the presence of 3,076 ETFs, it can be hard to pick the perfect one for you. So in this video, we will list down 10 of the most promising ETFs in the market. But do keep in mind not to just invest your hard-earned money blindly. Even if it is the best performing ETF, you still need to invest wisely and not get impulsive. Welcome to the School of Smart Ideas. This is the ultimate destination for financial empowerment. Here, we decode the secrets to smart hustling and clever investing. So hit subscribe, ring that notification bell, and let's build wealth one strategic move at a time. Before we get into the list, maybe you would be wondering what makes an ETF better than all the others. While the specific answer can only be answered by doing the due research into a specific ETF, some specific qualities to analyze can be 1. Understanding the underlying assets. You take a look at what kind of asset class does the ETF track? Is it broad like the entire US market, VT, or specific like tech stocks, QQQ? This will be a big help for you to analyze your investment goals and risk tolerance. Then you can take a look at its diversification. How many individual assets does the ETF hold? A higher number indicates broader diversification, reducing the risk of individual companies underperforming. Now you analyze the tracking error. How closely does the ETF's performance mirror the progress of its underlying index? A lower tracking error score shows efficient fund management. 2. Understanding the cost and fees. Expense ratio. This is the annual percentage fee charged by the ETF platform for managing the fund. Lower is better, means you get to keep more of the profit you make. Consider the trading costs and the commissions associated with buying and selling the ETF. To explain better, imagine you go to buy an apple and the shopkeeper charges you an apple buying fee. That would be like the trading cost. 3. Understanding the liquidity and traded volume. Look at the average daily volume. This indicates how easily you can buy and sell shares of the ETF without impacting the price. Higher volume is preferred for easier trading. Now analyze the spread, which would be the difference between the buying price and selling price of the ETF. A smaller spread reflects higher liquidity and reduced trading costs. 4. Understanding the investment objective and strategy. You also must look at the nature of the ETF. Does the ETF passively track an index or actively try to outperform it? Passive ETFs generally have lower fees, while active ones might offer the potential for higher returns but with increased risk. 5. Understanding the fund management and issuer. Next would be the track record. How long has the ETF been around? Has it consistently met its investment objectives? You also have to take into account the reputation of the issuer and their experience in managing similar funds.
Well, Dave Ramsey's against ETFs. I'm not against ETFs. I don't mind. What I don't want you to do with an ETF is start buying and selling all the time. By the time the news is good on the stock market, you're late. You should have already been in. By the time the news is bad, it's already too late for you to get out. I'm just saying, but in general, if you're trying to use an ETF to time the market, we call it, then that use is not something that, that we would tell people to do ever.
So now you know the difference between a good ETF and a bad one. So we would suggest you keep an eye out for the following ETFs. 1. Vanguard Total Stock Market ETFs, VTI. The OG of diversification, VTI tracks the entire US stock market, giving you exposure to big names like Apple, Amazon, and Tesla. Think of it as your all-access pass to Wall Street's roller coaster, but with the safety net of a diverse portfolio. 2. Vanguard S&P 500 ETFs, VOO. This ETF focuses on the top 500 US companies, the best of the American stock exchange. Think tech giants, healthcare powerhouses, and consumer staples. Imagine owning a tiny piece of every household name in the country. That's VOO. 3. Invesco QQQ Trust, QQQ. Buckle up for tech heaven. QQQ tracks the NASDAQ 100, meaning you're betting on the future with Apple, Google, Microsoft, and other tech titans. This one's for the risk takers, the innovators, the believers in the power of Silicon Valley. 4. A-Shares Core High Yield Corporate Bond ETFs, HYG. Not all heroes wear capes. HYG takes on the unsung heroes, high-yield bonds. These offer higher returns but come with some risk. Think of it as lending your money to companies looking to grow, like a venture capitalist with an ETF's twist. 5. SPDR Gold Shares, GLD, the ultimate haven. GLD lets you own a slice of the shiny stuff. Gold shines even when stocks sputter, making it a valuable portfolio diversifier. It's like having a fire escape for your investments, gold-plated of course. 6. Vanguard Small Cap Growth ETFs, VBK. Don't underestimate the little guys. VBK invests in smaller, up-and-coming companies with explosive growth potential. Think innovative startups, disruptive technologies, and the next Amazon waiting to be discovered. 7. iShares Global Clean Energy ETFs, ICLN. Go green, make green. ICLN taps into the booming clean energy sector with companies developing solar, wind, and other renewable technologies. This is for the eco-conscious investor who wants to profit from a cleaner future. 8. SPDR S&P Emerging Markets ETFs, VWO. Diversify across borders. VWO takes you on a global adventure, investing in companies from developing economies like China, India, and Brazil. This one's for the bold explorers seeking high growth potential outside the US. 9. ARK Innovation ETFs, ARKK. Prepare for the future. ARKK is all about disruptive technologies, from artificial intelligence to robotics to genomics. This one's for the sci-fi fans, the early adopters, the believers in a world transformed by tech. 10. SPDR S&P 500 Dividend Aristocrats, ETFs, CARE. Income with a pedigree. CARE invests in companies that have increased their dividends for at least 25 years straight. Think of it as royalty checks from reliable businesses, like your own personal money machine. We would suggest you try out Robinhood for your trading needs. With one of the most expansive selections of ETFs and ample information for newbies to make an educated decision, Robinhood is one of the best trading platforms available. Another beginner-friendly platform would be Fidelity Investments. With top-class education material and a simple but innovative interface, it makes understanding the qualities of an ETF super easy. So go ahead and grow your wealth. Leave no page unturned in your research into any assets that you invest in. Understand the pros and cons of everything. Subscribe to the School of Smart Ideas and make informed decisions to minimize your losses.